everyone, welcome to the meetup session for our multi-bagger research series program. And a very special welcome to all the new joiners here, whom we are meeting for the first time. This is Fanyam, and we have Rupam here. We are the co-founders of MoneyWiseSmart. And we also have Sean here, who is our head of marketing. We really appreciate you being here on this Thursday. We know your time is valuable, so we promise the best value for your time over the next 1.5 hours. This meetup is for two groups of people. You are either someone who has invested before or someone looking to start investing this year. If you have been following the markets, you'll know that stocks have gone through significant volatilities recently, collapsing last year and causing many people's portfolio to drop by half, and rebounding this year with the S&P 500 almost recovering to its previous peak. Some people who could not stand the volatilities and sell off their holdings when they were down are probably regretting the decisions or feeling angry now. We know that it's not easy, which is why we are holding this meetup. So in today's webinar, we will talk about 3 key topics. First, we will talk about how we can go about doing our portfolio reviews to assess your companies properly and not panic and sell on good companies when they are down and miss out on subsequent gains. We will also discuss the framework that we use to look for red flags in our initial research of a company or the subsequent portfolio review, and our forensic analysis findings on some companies submitted by our lifetime MRS subscribers. And lastly, we'll quickly talk about some updates for some MRS companies. So we are doing all this because we want to help more people get access to proper financial education so that they can manage their portfolio better and achieve the freedom that they deserve. Before we begin, I just want to be open about something. As you can probably tell, we are not professional speakers. We don't hold webinars every week, and we actually spend most of our time researching companies in depth because these are companies we are personally invested in. And as you can see here, we have been doing this long enough for Rupam to have lost all his hair compared to the picture. Yeah, so we are definitely not the most entertaining speakers, but we can show you how an investor actually thinks and allocates his money. So we'll share a lot of stuff today that could be eye-openers for you, and you'll only derive full value if you stay till the very end. So let's start by talking about portfolio review now. So broadly speaking, we can see the portfolio review session, be it a mid-year review or a year-end review, or maybe if you do it 5 times in a year, then the portfolio review can be seen as constituting these 5 main steps. And we assume that most, if not all of you, have already defined your own investment strategy. And since these portfolio review steps apply to most investment strategies, we will focus mainly on the 2 steps highlighted in the blue box today. In particular, evaluating the business performance of your portfolio companies and assessing the management's latest capital allocation activities, since capital allocation is a very important factor determining the shareholder return in the long term. Let's now talk about how to evaluate the business performance of the companies in your portfolio or in your watch list. The portfolio review should, in general, be restricted to evaluating the fundamentals of the business alone and not share price movement. So what business or portfolio performance should we focus on during our portfolio reviews? We'll focus on these 5, basically evaluating the business fundamentals, evaluating the moods of the companies, looking for red flags, and seeing if there are any extreme overvaluations of companies, and if there are laggards in our portfolios that we want to replace. On business fundamentals, there are so many financial metrics and quarterly business projections. What should we focus on? So his full name is Terry Smith. He's a successful British fund manager, and he focuses on 5 operating metrics to track the business performances of his portfolio. And we at MoneyWiseSmart focus on the same 5 metrics too, where we want to track and ensure that these metrics are healthy and improving over time. The most important metric for us is ROCE, which stands for Return on Capital Employed. Basically, how much operating profit a company earns for every dollar of capital that it employs. In the long run, the investor performance cannot be too different from the return on capital of the underlying business, which is why this is a very important metric for us, and we want to ensure that we keep improving the overall ROCE of our portfolio of companies. Next, we want to ensure that the gross margins are at least stable, if not improving, as any decline could indicate competitive pressures or a deterioration in pricing power. Third, on operating profit margins, they could fluctuate if a company is over or under investing in any particular period, but a sustainable decline could indicate a drop in efficiency of the company. Fourth, we also want the cost-cash conversion ratio to be healthy to ensure that our companies are actually converting those profits into free cash flow well, and that there's no material deterioration of working capital efficiency or increase in capex requirements. Lastly, but very importantly, we want to see if the balance sheets of our companies are still healthy with high interest covers, so that we don't have to worry about any risk of them defaulting or facing bankruptcy. So this is how our top MRS companies have been performing on these 5 metrics. Our objective during portfolio review is to keep track of them and ensure that the metrics are healthy and improving. As you can see here, for the past 7 years, these metrics have been overall improving. Most importantly, the ROC has been improving over the years, from low 20s in the earlier years to close to 30% in the last 2 years. You see that ROC did drop in 2020 to 24%. That's partly due to COVID-19. However, we were not concerned at all because all our businesses have strong balance sheet. Either they were in net cash position as indicated by NA in the table, or if they were in net debt position, you can see here they have very high interest covers. So we knew that they would not have any issues surviving any prolonged slowdown in businesses and would likely emerge stronger thereafter as the weaker competitors get weeded out and their ROC would improve. Just as a reminder for our new MRI subscribers, we track the performance of the MRI companies on these 5 metrics together with their main positive and negative points and their valuations in our MRI company's summary valuation Google Sheet. And you as a MRI subscriber has access to this sheet with all these details at your fingertips, so you can see and track the performance figures there easily. This is how we make our subscribers' life easy. And for people who are not MRI subscribers, we would strongly recommend you to have a summary sheet too, so that you can track your portfolio of companies easily to help you with your portfolio review. Sometimes during our portfolio reviews, we do discover issues of deterioration in business fundamentals for our portfolio companies. As an example, we used to cover a Hong Kong listed company, but when it changed its business model with a negative impact on its ROC, we updated our subscribers and exited the company at a loss of negative 4% XIRR. What's important is that portfolio review and decision to sell off the shares help us to subsequently avoid further losses and a current trading suspension. And we managed to recycle our capital to higher quality companies to continue compounding our capital. There has also been examples of us selling a company when it becomes too leveraged, like Tor Industries. During the time of COVID, it took on massive debt for an acquisition and became too leveraged to our liking. We did not like to speculate whether it could fulfill its debt obligations throughout such tough times, so we sold off our holdings. And although the company managed to subsequently reduce its leverage, it was not certain or knowable beforehand, and we were not ready to take on that risk. So an increase in leverage is the area we are most cautious about. So if we see a company suddenly taking on a lot of leverage, we want to stay away regardless of how lucrative the potential upside can be. As that would be like driving with a knife in front of you on the steering wheel. Imagine like in a business world where many things are uncertain and can go wrong, that's definitely not a place we want to be in. The next step in our portfolio review is to re-evaluate the moods of the companies. In the business world, businesses are destined to go through ups and downs and be affected by the changing macroeconomic environment, so the financial performances could fluctuate a lot in the short term. And we as investors should not be focusing too much on these short-term fluctuations. What matters more is in the long term, the economics moods of the company are still intact, as the moods are less volatile and they determine if a company can consistently earn high returns on capital in the long run. So our time should actually be spent on evaluating whether the company's mood is still intact or widening or shrinking over time. For example, let's look at Meta. I'm sure most, if not all of you know this company. So its advertising revenue, mainly coming from Facebook and Instagram, is heavily affected by the macroeconomic environment and customer demands, which vary over time. As seen in this chart, the growth of its revenue has been volatile over the years, with the growth being even negative in the last year. However, if we focus on its active users and the user engagement instead, we can see here that they have been stable and growing over the many quarters. Meta's moods largely depend on this network effect. So as long as the number of active engaged users are stable and growing, they will attract more users to join the platform or the existing users to stay with the platforms. And Meta's moods will be intact, which help it to grow and earn a high return on capital over the long run, despite the short-term fluctuations in financial performances. So the point here is, when reviewing your company's performances, focus more on how the moods are evolving instead of the short-term financial fluctuations. Next, in our initial research and the ongoing review of a company, we constantly look out for red flags, and Rupam will tell you how we do so later and some of our findings on some companies. So earlier we said that the portfolio review should in general be restricted to evaluating the fundamentals of the business alone. However, there are times of extreme share price overvaluations when we would consider switching our companies. Here's a question for all of you. If you estimate that the value of a business is $1 billion today, and if you expect it to grow its earnings and intrinsic value at 15% a year over the next 10 years, after 10 years, roughly how much would you expect the value of the business to be? So in 10 years time, the value of the business would grow to 4 billion, so close to K and what you say, 3, mean 4. You can use a rule of 70 to do a quick math, or you can compound it. by yourself. So 1
Yeah.
billion after 10 years is about 4 billion. And let's say you buy into this business today at its intrinsic value of $1 billion. If for some reason the share price shoots up by 30% in the first 6 months, so you get a 30% gain, and the market cap becomes 1.3 billion, what would you do? Would you sell the business and take the profit? Or would you remain invested? Let's see the preference of everyone here. There's no right or wrong answer, depending on the type of investor you are. Who would sell? Okay, by what would stay invested? The rest? Not sure what to do. Zico will stay invested. Anyone who wants to sell? If no one is selling, by what cannot buy more if he wants to buy more. Okay, seems like no one is selling. Sell some. Okay, Joe will sell some. Eric will stay invested. Okay, so for us, we will evaluate the expected future returns for the remaining 9.5 years. And in this case, it turns out to be about 12.7% a year. So as long-term business owners, we will not think of exiting the business since the returns are still pretty good. And we will have reinvestment risk if we sell. However, if the overvaluation is extreme, for example, if the share price and market cap shot up to 3 times instead, then the expected future returns drop to only 3.2% per year. So those who stay invested, would you sell now? So for us, in this case, it does not make sense for us to continue staying invested in the company, especially if we can find other opportunities offering us a much better expected return than 3.2%. So although we would not think of selling or trimming our positions in every instance of overvaluation, sometimes extreme cases of overvaluation will offer us opportunity to switch sensibly. We are not really selling, but we are switching to other companies. Okay, next, another question. If a Ferrari raises a Toyota, which one do you think will win the race? Any car enthusiasts here? Anyone? So I think everyone would have their own answer. Now, what if the Toyota gets a 500-meter head start? Which one will win the race now? Any answers, any comments? Rubam says it depends just now for the question. What about now? Anyone? Do you want to drive a... Okay, well, what good answer? Depends if it's a long race or short one. That's exactly the answer. So you have to decide whether you want to own a portfolio of good Ferraris at reasonable prices or a portfolio of Toyotas available at very good prices. And maybe in the past, you bought into some Toyotas at good prices, or maybe the companies you bought turn out later to be Toyotas instead of Ferraris. And if your investment strategy is to own a portfolio of wonderful companies for the long run, where you'll be driving the Ferrari for a very long distance, then it will make sense for you to upgrade your Toyotas to Ferraris, basically replacing your laggards in terms of quality with the better companies at the opportune times. For example, if your Toyotas are earning 10% ROC now, while you find Ferraris that earn 20% ROC at reasonable prices, then in the long run, owning the Ferraris is more likely to provide you with higher returns. And MoneyWiseSmart, that's what we've been doing. We've been replacing our Toyotas with Ferraris, where in the past we used to invest in Pax Global and Insperity. Back then, although we did not think they are the best companies with the strongest moats, they were pretty good companies available at very attractive prices. So the investment returns could be good. We invested in them, and when good opportunities came for us to exit positions in them and recycle capital into better Ferraris, we did so to enhance our portfolio quality. Now, let me tell you a story. So 2 months back, Rupam and I were in India to attend some investing programs. And we were amazed by this story of one investor lady we met there. So this lady, she came from Gujarati, a community that boasts some of the smartest business people in India. By the way, this picture is not her. So after her wedding, because she has an accounting background and she has interest in the stock market, her grandfather-in-law actually entrusted her with 3 bags full of share certificates of different companies that the family had owned. And so she had to liaise with the respective companies and get those certificates converted into dematerialized form. And one of the share certificates is for this company. Who knows this company? Have anyone heard of it? Probably if anyone in India or who have been to India might have seen this company. Why what types of why? So for those who do know, this is Asian Paints, which is the largest paints company in India that was started 8 decades ago. And is a good business and has been performing very well as a business for many decades. Just look at the share price performance over the long term. Google Finance only has data from 1999 onwards, and from then it has been a 300 bagger. But the company actually IPO'd earlier, and based on publicly available data from 1990 to now, it has been a more than 1,000 bagger in about 3.5 decades time. And for this investor lady and her family, what have they done? They have actually been holding on to the shares since its IPO, achieving a more than 1,000 bagger in their portfolio. Do you think that's impressive? Who thinks that this is impressive? A 1,000 bagger in one generation's lifetime. Imagine the kind of wealth creators. If you have put in $10,000, it would have been worth more than 10 million now. But do you think it's easy to achieve that? Yeah, Sharon, when we heard this, we were like shocked, Rupam and I. So is it easy to achieve that? What can be stopping the many people who live in India, they actually use Asian pens for their own homes, from achieving such multi-bagger returns in one generation's lifetime? The answer is volatility, which might not be obvious from this chart. But let's look at this table. In the past 15 years, Asian pens shares have gone through significant volatility, where every year, the drawdown from the peak was about 18% to 63%. Imagine if you have bought the shares during IPO, it's become a 100 bagger for you. And then in 1 year, it suddenly dropped by 60%. That means your 100 bagger suddenly became a 40 bagger. How would you feel? And what would you have done? Sharon, what would you have done? Would you have been able to hold on like this investor lady?
No, I think I probably would have panicked.
Okay, yeah, I agree. I think that's what most people would do. So which is why we are talking about this today. So if you focus on the business, just the business performance, then we would have a higher chances of holding on to the shares without looking at the share price. So over the years, Asian Pen's quarterly sales here have been growing well with solid profitability, and all this growth will also achieve with a high return on capital, which is a very important metric that we have mentioned earlier. And that's what this Indian lady has been focusing on for the past few decades, instead of the fluctuating share prices. Rupa and I had actually spent 3 days with her in our classes, and her calmness is just telling. You can see that she was so calm. So the question for you is, do you want to be the same and achieve such tremendous returns in your portfolio? Now let's talk about capital allocation, which is one aspect that most investors miss out because evaluating it requires more work. But we as investors have to pay attention to capital allocation because, as Warren Buffett says here, it has an enormous impact on the value of a company over time. Even if a company's operating performance is brilliant, but if the management's capital allocation skills are not good, then the shareholder return might not be good, especially in the long run. So what's capital allocation? Let me explain this using a simple example. Here we have Sean, who is a businessman, and he has $100,000 of capital, and he enters into a apple trading business. In the first year, he uses all the 100,000 to buy apples from the farmers, and he sells them for 120,000. How much profit does he earn? Yeah, he earns 20,000. Assuming for simplicity purposes, there are no other costs, no needs for working capital or capital expenditure. He will be earning $20,000 of net profit or free cash flows, and his return on capital will be 20%, which is 20,000 divided by his 100,000 capital. So this 20% is a pretty good return. Now, next year, Sean has $120,000 of capital because he had just earned 20,000 more. What does he do with this capital? One option is for him to reinvest everything into the business. So he buys $120,000 of apples, sells them for 144,000, earning 24,000. And that's again a return on capital of 20% on the whole capital, the increased capital of 120,000. But what if the total market size is only 120,000? One option for Sean is he just buys $100,000 worth of apple, just like last year, and then sells them for 120,000 and earns a 20% return on the $100,000 of capital. And then he has an additional $20,000 capital. So he puts them into the bank, which earns him about, say, 3% annual interest. And in this case, his overall return on capital on the whole $120,000 of capital now will be less than 20% because he has allocated the new $20,000 capital to low earning assets. If he has allocated that capital to something else that earns a higher return than 20%, then the overall ROC would have been higher than 20%, which is what the operating business is earning. And that's how different capital allocation activities can have different impacts on the economics and value of a business, and why great capital allocation matters in simple terms. Now let's look at another example to give you more idea. How many of you here are familiar or roughly familiar with how a discounted cash flow valuation works? In short, is a DCF valuation, discounted cash flow. If you are familiar, type yes, just so we get an idea how many. So yes, by what? Yeah, we have some people. Not everyone, I think, but quite a few. Okay. Yeah, if you are not familiar, feel free to type no too, so that I'll take a bit longer, spend a bit longer time on this. So let's look at this simple DCF example now. And please take note that we are not recommending you to use DCF to value a company. This DCF example is purely to illustrate the concept, and we have simple valuation methods to value our company. So I think this will be good news to you. And just follow me with this example. So for this DCF example, now we are in year 0, and we project that in the next year, the company will generate 10 million of free cash flows. And that free cash flow will go by 20% every year for the next 9 years. And just for simplification purposes, after year 10, we assume the company is worth nothing. If we use a discount rate of 50% to discount all these future free cash flows to today's terms, then the company would be worth about $106 million today. My question here is, if in year 1, if the company grows as projected and is still expected to grow and have the same future free cash flows, how much would the company be worth at the end of year 1? At year 0 is 106 million. After 1 year, how much would it be worth? Let's see some answers. Everything is exactly the same. The business performs as expected. So it seems like this question might be a bit tough. So after 1 year, the value of a company would have grown by the discount rate amount. And because the discount rate we have used is 15%, so here we'll use 106 million multiplied by 1.15, and we'll get 122 million, or John is even more precise here, we'll get 121.9 million. So John, you're right. Basically, the value would have grown by the discount rate. That's how a DCF works. So the other way to look at it is imagine after 1 year, we do the exact same DCF again, but now we are 1 year in the future. So the previous year 1 would have become year 0, and then from now on, the new year 1 onwards till year 9, we have the same amount of projected free cash flows because the business has performed as expected and still is expected to have the same future performance. Now, if we run this DCF again, we discount them by the same 15% discount rate, we only get 112 million, less than the 122 million calculated just now. Can anyone guess like what happened? Why is this different? This question might be a bit harder, but feel free to give it a shot. Maybe John also knows the answer. Okay, let's review the answer. So the difference in 10 million is because in previous year 1, we assume that the company will have generated $10 million of cash, right? And we assume that that cash will have been available to shareholders by the end of that year. So that's what happens in the DCF model. But we need to see what actually happens in the real life, because we are buying the real business. Is the cash really available, or are they reinvested in a rate of 15%? Maybe the cash is distributed out as dividends to the investors. That's why the value when we do a new DCF now drops by 10 million. And if the investor has opportunities then to reinvest at 15%, which is the discount rate, then yes, this whole investment would have been worth 122 million as originally calculated. Or the company could use the $10 million cash for share buybacks, and depending on the buyback price, then the returns of the cash used for buybacks could be significantly different from the 15% discount rate, and the actual value of the company can differ accordingly. Or the company could be holding the cash for now and put in the bank account earning low risk, just like shown in our previous example, which makes this whole investment worth less than 122 million calculated. So I hope this is clear to everyone. Now, do you see how capital allocation activities of a company can affect the value of a company? And why is an important factor affecting the value of a company in the long run, given that compounding effect? And just read these words from Warren Buffett. And in this example, that $10 million of cash in 1 year would have grown to 55 million after 5 years. Now let's look at how we can actually make portfolio changes during our portfolio review, depending on how we observe the capital allocation of the companies to be. First, there are companies which have bad capital allocation, despite a strong operating business like JD.com. When we invested in it, we knew its capital allocation was not the best, but decided to give it a benefit of doubt. But over time, it had continued to allocate capital badly. So when we got the opportunity, we reduced our holdings in it over time and switched to companies with better capital allocations. We also have Shopify in this camp, where it was deploying massive capital to the fulfillment network SFN with unclear returns. But now that it has stopped doing so, we have moved it to the neutral capital allocation category and observing it more closely. Next, we have some companies with neutral capital allocation skills, so we continue to observe them. And then we have companies in the good capital allocation camp, which are deploying capital to areas with high and more certain returns. So for these companies, we actually accumulate more of them when the prices are good. The point today is not to discuss the capital allocation skills of each of these individual MRS companies, as we have already discussed them in our detailed research. The point here today is, depending on how you assess the capital allocation of your companies to be, you can decide whether to reduce, add, or continue observing them as part of your portfolio review. And then MoneyWiseSmart, we focus on finding companies that not only perform well operationally, but also have good capital allocation. Like the ones in this bucket, And we only accumulate positions in the company if it is clear that the capital allocation is good. And that's where a lot of work needs to be done to assess the capital allocation over time. And that's where we can help our MRI subscribers in evaluating them. And remember that the capital allocation skills can be completely different from the strength of the operating business, just like JD.com here. So we have to actually evaluate these two components separately. After evaluating the business fundamentals, moods, and capital allocations, it's time to make decisions. If there are no major issues or new red flags, then most of the time we don't act. Sometimes the best action to take is to not make any changes. This way we get to make less mistakes in our decisions and also incur less transaction costs and taxes. We have learned this from these successful investors here, who have some of the best track records in the world. And they've also all learned from Warren Buffett and Charlie Munger and the likes. For example, Terry Smith here asks us to do nothing after buying the good companies. Nick Slip, who ran the Nomad Investment Partnership, used to say that his portfolio transactions had grounded to a total halt at one point, no action at all. And he considered his portfolio inaction to be considerably value-adding for his investors. And Pulak Prasad, who runs the Singapore-based Nalanda Capital, asks us, don't be lazy. Be very, very lazy. However, one thing to take note is that we can actually only afford to have this luxury of being lazy only if we have initially selected companies that are of really high quality with good capital allocations and without any red flags or big risks. So that's a very important caveat. And many of you would have heard of this. The second best long-term performer is usually the investors who has forgotten his or her brokerage account password. Then who is the best performer? Well, it's the investor who is no longer alive because they can't make changes to their portfolio. And we can strive to be like one. Just like how that Indian investor lady has done nothing to her Asian pens share to achieve a more than 1,000 bagger in her portfolio. It's crazy. So in MoneyWiseSmart, following the portfolio process, this has been our portfolio performance. And I mean the operating performance, not the share price performances, where we have been accumulating and replacing laggards with higher quality companies at opportune times to own a portfolio of good companies with good and improving ROC, profit margins, and free cash flow conversion. Earlier, the ROC of our overall portfolio used to be in the low 20s%. But within our portfolio, there are companies which are of higher quality with higher ROC. So over time, we have been accumulating more of these higher quality companies when we get to buy them at good prices to improve the overall quality and ROC of the portfolio to high 20%, close to 30%. And we expect our overall ROC to continue improving in the future. Right now, we are in the middle of evaluating some great companies that are of very high quality with very high ROC. So if we find them attractive after our research and include them in our portfolio in the future, that will help us to improve our ROC even further. And on share price performance, using our investment strategy and the portfolio process, we have been outperforming S&P 500 for over the past 4.5 years, as shown by the blue line here, which is the performance for Indigo Atlantic, the parent company of MoneyWiseSmart, versus S&P 500, the green line. And there are definitely drawdowns, as you can see here over time, that no one can escape. But the relatively higher quality of our companies help us to perform better than S&P 500 in the long run. Although a difference now of between 100% return for us versus 60% for the S&P 500 might not seem a lot, over time that actually compounds and it can lead to a massive difference. So now I'll pass on to Rupa to talk about how we look for red flags and the findings of our forensic analysis. Well, over to you.
Thanks, Fan Liang. So forensic analysis. Now, just to give a background, last time we had invited our subscribers to submit names of companies that they would like us to kind of do a deep dive without really being emotionally attached with these companies. So the very nature of a forensic analysis is, just like our research, this is completely fact-based. I'm going to today cover 3 companies, and you will notice that I will not give a single opinion of mine here. What Rupam thinks or what Fan Liang thinks doesn't matter. Everything that I will be presenting is pure facts that I have discovered, both good and bad, from these companies. Now, in the short term, sometimes we have significant run-up of the share price, and that can happen either due to a sudden significant improvement in fundamentals or amazing streaks of luck. I mean, it remains an amazing streak of luck if someone manages to exit right at the top. But more often than not, it is the latter. It is amazing streaks of luck. That is when it happens in the short term. But when a run-up like this happens over a long period of time, a long-term performance like this is just not possible without, number one, great fundamentals, and more importantly, great capital allocation, which is a CEO's primary job, which Fan Liang just explained what it means. So with that out of the way, today we are going to discuss the forensic analysis of these three companies, Palantir, Par Technologies, and C Limited. Now, we haven't selected these companies. We have absolutely no opinion of ours. We don't have positions in these companies. Neither are we planning to hold positions of in these companies. We asked our subscribers to submit, and they submitted the names, and we just took the top three popular names. So that's how we came across these three companies. And also, disclaimer, before we actually did the forensic analysis, I knew literally nothing about the top two companies, Palantir and Par, but of course, subsequently, we studied these companies. So we start with Palantir Technologies. Now, before we dig deep, let us understand this concept of share-based compensation. Now, the easiest way to understand what share-based compensation is often we focus on growth, completely ignoring share-based compensation. Share-based compensation is nothing but the number of slices of pizza increasing as the size of the pizza increasing. So whether each slice owner is actually better off or worse off, that you can't say just from this picture. So SBC acts in a very similar way. Now, be very wary of a business which pretends that the SBC does not matter and does all their internal, as they call it, non-GAAP adjusted calculations, ignoring the SBC. Now, what I realized is that Palantir Technologies is Palantir is one of those companies. I mean, multiple places they highlight the fact and kind of proudly that we use non-GAAP measures, contribution margins, gross profit, blah blah blah, to evaluate the numbers, pretending that SBC does not matter. So that immediately raises my antenna. So I went ahead to see what their SBC looks like, and this is what it looked like over the last 3 years. Now, when we typically look at SBC as a percentage of revenue, and I mean, the companies that we like typically have SBCs of mid-single digits, whereas Palantir in 2020 had a share-based compensation of over 116%. That came down, but still it is very significant, close to 30%. Now, the worst part is that this is not all. The story doesn't end here. As of December 31, 2022, the total unrecognized stock-based compensation expenses related to RSU, that is restricted share unit, outstanding was 770 million, which is expected to be recognized over the next 3-year period, which is not included in that SBC that is mentioned above. So, as you would have guessed, that the number of slices of pizza will increase very significantly going forward. Now, let's look at working capital efficiency. Now, essentially, a business, for every business, it starts with cash, and then with that, the business buys raw materials, then finished goods, then they sell the finished goods, they collect money, and then that results in cash. So that entire cycle is the working capital cycle, and it is extremely important for us to look at the efficiency of this cycle. Now, there are many businesses which you will see that are showing amazing growth, but if you look under the bonnet, you will realize that, while the revenues are growing, they are not exactly being able to collect the money fast enough, and that directly affects the free cash flow. And that's the reason why it's very important to understand the working capital cycle of a business. So let's see how Palantir is doing on that front. Now, you can see the days sales outstanding. In 2018, it used to be around 12 days. And that has, over the years, shot up to 57. And as of 30th June, it's at 65 days, which means, in simple English, it used to take Palantir 12 days to collect their money, the sales revenues, whereas now it takes 65 days to collect their money. So for 65 days, the customer doesn't pay them. So it's becoming less and less efficient. Now, payables, which is basically what they owe to their supplier. So that is exactly the opposite. The longer you have to pay your suppliers is better for you, because you get to use that cash. As you can see, in 2018, they used to take about 60 days to pay their suppliers, and that has come down to 26 days. Now, I saw the 30th June figure. I was very surprised. Now, I did not have much incentive to look into why the number is just 4 days. It is 4 days. I did the calculation. There is nothing wrong. There might be some other truth here. But even if I look at the figure from 60 days coming down to 26 days, it's a significant deterioration of working capital efficiency. I mean, that's not good. Next, let's come to something called contractual obligations. Now, when we evaluate a business, we study their balance sheet. And on the balance sheet, we have the liability side of the balance sheet. The asset side is what the company invests in, and the value is created on the asset side. And the liability side basically lists down all the sources of funding that the company uses to fund those assets. Now, debt, equity, these are all different sources of funding. Now, sometimes businesses have their contractual obligations which don't show up on the balance sheet, but those are typically small, and it's not something that we usually pay attention to. But when the contractual obligations are very significant, then we better pay attention to that, because the company and these contractual obligations are typically non-cancelable purchase commitments, which is what is mentioned in the footnote. So Palantir has a total contractual obligations of close to $1.3 billion. Now, just $1.3 billion is a meaningless figure unless we compare it with their balance sheet size. And both these figures are as of end of 2022. So as you can see, this is almost half of their total equity, which actually is a very, very significant number. And if someone is just looking at the balance sheet, they might think, oh, you know what, they have $2.6 billion of cash. But then you immediately need to be reminded, but then they also have $1.3 billion of contractual obligations, which does not figure anywhere on the balance sheet. So that is something that needs to be kept in mind. And when we research a business, we are always looking for red flags, and I call them cockroaches in the kitchen. As the saying goes, there is never just one cockroach in the kitchen. The moment you identify one, you can be sure that there are many. So I very consciously chose this very graphic, yucky looking picture. Now, when we were researching their G&A expenses, I noticed that Palantir spent $15 million in professional service fees, mainly related to legal and financial services, and $10 million allowance for credit losses, which is okay. But $15 million in legal fees, so I dug a bit deep, and this is what I came across. The company is facing securities class action complaints and stockholder derivative actions that allege false and misleading statements and breach of fiduciary duty by certain current and former officers and directors. So that itself is a huge red flag for me. Now, as I said, I don't own the company. I don't have any opinion. But normally, when we are researching a company, I mean, with so many red flags, I mean, chances are very high that we would have moved on long back. But there is one more thing I wanted to go and check, which is that do ordinary shareholders, can they do anything about these things? And I realized that based on how their voting stock is, the class of their voting stock, there is something called a class F voting stock, which basically, I mean, if I just summarize this, which tells you that ordinary shareholders have absolutely no say. As long as the founders are there, this is a funny, there's a variable number of class F stock, which essentially ensures that the founders will always effectively control all matters submitted to stockholders for approval, including the election and removal of directors and significant corporate transactions. So in spite of the corporate governance issues and those cockroaches, there is absolutely nothing that ordinary shareholders can do. So that brought me to the next question, which we typically ask whenever we research a company, that what are the other smart investors doing? Now, there is one website which we regularly visit called dataroma.com, which lists all the purchasers of the super investors, basically the top investors around the world. So it lists out all the activities. So whenever you're researching a company, it's a great idea to go and check on Dataroma that who are the other smart people who own this company. Now, when you see this is not a good sign. The ownership count is 0. That is, there is not a single super investor who owns this company. Now, unless I am a shareholder of Palantir, and unless I think that I am so extraordinarily smart that, I have identified this hidden gem which no one has identified. I mean, as I said, I don't have any opinion, but you have to take a call and decide that how likely it is that only you have been able to identify a hidden gem which none of the super investors have. And the other thing which struck me is, in spite of Palantir's share price crashing, no insider has ever purchased the stock, even after the share price has crashed. So these are my findings. Again, there is no conclusion here of a forensic analysis. I just wanted to present my findings. So you have to draw your own conclusions based on these facts. And each of these are facts which I also showed you where these facts came. They all came from the company's own documents. So next, we move to this company called PAR Technologies. Now, there is one thing which I noticed, that PAR Technologies has some large restaurant chains as their clients. There's something which I found a bit weird, but that is not exactly a red flag. That is, I used to think that they are only in this restaurant solutions business, but later I realized that they also have the government as their customers, and they're into defense and all. So that to me is a bit confusing, but who am I to comment? However, the part which to me looked slightly risky is that the two of the largest customers of theirs, they represent 22% of their total revenues, which can be a bit risky, which means that one large customer, if they lose, that takes away a significant chunk, a material chunk of their revenue. It's not going to be a showstopper for them, but at least we should be aware that this is the case. However, the good thing about PAR Technology is that they have something called the annual recurring revenue. So that is an advantage of all these SaaS model businesses. For those of you who are not clear what it is, typically a company would invest in a sales and marketing team, and they would go and do the selling, and they would maybe win an account and generate some revenues. But when a company has annual recurring revenue, the advantage is that it is kind of automatic. So the company is not expected to invest in sales and marketing activities to keep that tap on, and because of this, their growth in revenues has been quite impressive. That is 29% CAGR. However, their growth in operating expenses has been almost double of that. That is 53% CAGR. So that immediately raised my antenna. That is, if you are a business which is supposed to have a lot of ARR, which is annual recurring revenue, how come you would expect a business of this kind to have massive amount of operating leverage. But here, what we see is exactly the opposite. And if you look at the selling, general and administrative expenses, this on CAGR terms, this I think works out to close to 45 or 47% CAGR, which is quite high. But then, someone might say, hey, Rupam, why are you just looking at 3 years figures? Let's look at a longer term figure. So I went and looked at the longer term figure, and there the situation is equally bad. Over the last 9 years, their sales growth has been a CAGR of just 4.4% CAGR, but their total operating expense has grown at a CAGR of 12.3% CAGR. Now that is definitely not good, and there is no amount of explanation that that can justify this, because this is pure number which is staring you at your face. So then I went and wanted to look at their balance sheet as usual, and this is what I see. That while it's, by the way, a loss-making business, so while their shareholder equity has been dropping, it has dropped significantly because of their accumulated deficit. Their balance sheet is getting more and more leverage. Their long-term debt has jumped from $306 million to almost $390 million. Now, that definitely should be concerning to the people who own the business. Now, some of them might say that, hey, but they also have cash. As of 30th of December, they had $70 million of cash, but as you would expect, it's a loss-making business, and that cash balance has come down to 44 million. Of course, they have short-term investments, but then that's not enough, because what they have will just vanish in 1 year because of this. As you can see, that their loss before the income taxes is close to $70 million. In fact, In the first half of 2023, it's about $35 million. So if I just annualize it, it's $70 million. And right now, they have the benefit of very low interest expense, even though they have high debt, because the debt is in the form of convertible notes. So they have the benefit of paying very low interest. But one thing is very clear, that this is not a cash flow generating business. So the cash has to come from somewhere, which means that they have to borrow more. Now, either they take on direct debt, in which case, as we all know, that the interest rates have gone up. So this interest expense is expected to go up quite significantly. Or if they manage to raise more convertible debt, now, mind you, their share price has come down quite significantly. So if they need to raise convertible debt, which means they are going to incur higher amount of dilution in future. So currently, this is how their convertible notes expire. Some, a little bit expires in 2024, and the rest expires in 2026 and 2027. But the interest rate risk, I mean, unless the interest rates significantly go down and again go close to zero and the share price goes up, they are going to face even higher amount of dilution going forward. And there is no escape from that, because one thing is very, very clear. At least there is no sign of the cash flows becoming positive. So if they run out of cash, they have to raise more cash. Unless, of course, suddenly magic happens and they turn around and they start generating a lot of cash. So let's see what are the chances of that happening. Now, so coming back to the ARR, this annual recurring revenue, the growth would have been impressive had it not been accompanied by 700 million of incremental capital the business has taken in over a decade. For a business of its size, if you are a SaaS business, and if you have a lot of ARR, you should not be requiring so much capital. But that is exactly what is happening, as we have seen in the past. So then I went ahead and I wanted to do a DuPont analysis, because I did not want to just focus on just 1 or 2 years figures. So I wanted to see what are the components which make up the return on equity. A DuPont analysis is basically it analyzes the return on equity of a business. Now, return on equity, as we all know, is net income divided by the total amount of equity, which can be broken up into a product of these three. That is the net income over revenue, which is basically the net margin. Now, a business can either try to be improving their net margin, or so it's net margin multiplied by the revenue over total assets, which is basically the asset turnover. So either a business can be trying to improve their net margin, or the business might have a very thin net margin, but they might be turning over their assets, very fast. I mean, there are examples of businesses which have wafer thin margins but very high asset turnover, or they might be employing leverage. Now, one thing we have already seen is that the power technologies is becoming more and more leverage. So let's see what's happening to the net margin and asset turnover. And here we wanted to look at it over a long period of time. And this is what I see. Over the last almost a decade, their net margin has deteriorated from just about less than 2%, minus 1.5% to almost minus 20%. And if you look at the asset turnover, that also has deteriorated. It has become much less asset efficient. So these are the things which cannot really lie. I mean, when you evaluate a business, at the end of the day, what your long-term shareholder returns will be, they can't be very disjoint from these facts. And we can clearly see that on all three counts, net margin, asset turnover, and leverage, the leverage is increasing, but I have denoted it with a red arrow that shows that on all three counts, the business is deteriorating, and that is pretty clear. Now, this is what is not showing up right now, which is the dilution, which is going to happen once these convertibles are going to mature. Now, there are some non-dilutive features, but then looking at their current cash flows, one thing is very clear, that you are going to see more hands reaching out for the pizza. So there is no escape from that. Now, there is something that I noticed in one of their annual reports, quarterly reports, which was a bit shocking to me. let me read. As most recently disclosed in our quarterly report, the blah, 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 our management concluded that our disclosure controls and procedures were not effective because of material weakness in our internal control over financial reporting attributable to deficiencies first identified in our control activities and monitoring activities as of December 2020. Now, this, they claim, seems to have been remedied subsequently, but only time will tell. So again, I did the same thing. I went to Data Roma to see if, okay, maybe, the people who own PAR, maybe they have some insights. So let's see if the same insights have been shared by any of the super investors. And this is what we see, that, none of the super investors own this. So these are some of the facts that I identified. Again, I don't have an opinion, but whoever owns PAR Technologies here, you should pay attention to these facts, because these are something which is going to affect your long-term returns, whether you like it or not. I mean, whatever the management might say. Now, always remember one thing: the management of the CEO, they are good salespeople. So that's the reason why the top investors like Warren Buffett, or we saw Pulak Prasad, they never talk to management, because when you're talking to the CEO, I mean, what do you expect? The CEO to tell you that things are not fine? No, I mean, they're typically good salespeople. They will paint a good story, but these are the numbers which cannot lie. So now we move on to our third company, which is C Limited. Now, in case of C Limited, and I know that there is a lot of interest which was there about C Limited. Now, in case of C Limited, there is one thing investors seem to have forgotten, that a good business does not necessarily equate to a good investment. So let me take you 2 years back, and here is an extract from a blog that was written in May 2021 by someone whom he's a friend. I know he's from Singapore, and probably many of you would be following his blog. And so one of our subscribers had shared this, and clearly he was also extremely bullish on C. So he was looking for confirming. So whenever we very strongly believe something, we look for evidence which confirms our belief. I mean, that is a very common trait, investor trait. So I read this blog, and this, by the way, is 2021, so 2 years back. Now, I highlighted something that he had mentioned, the person who wrote the blog. The price to sales ratio of 26 is high, and that's a risk. And all talks of risk ends here. And then he goes on to say, if we assume C has a 20% free cash flow margin today, it's like, if I thought of a parallel, like if I assume that I am the king of England today, then blah blah blah, and then his entire thesis is based on that assumption. I actually sat and scratched my head, and maybe that is the time when I lost a lot of my hair. A company which has no free cash flows, literally, he's assuming that the company has a 20% free cash flow margin, and that translates into a price to free cash flow ratio of 130, which essentially means a free cash flow yield of about 0.7. So mind you, this is 2021. Now, even though the interest rates, the US interest rates, were much lower at that point of time, it was about 1.6, but a 0.7 free cash flow yield was extremely low. You have to be really, really upbeat about bullish about the prospects of a business, and that is what this person clearly is. But we think the company has years of rapid growth ahead of it. C is currently participating and excelling in the high growth markets of blah blah blah, and at the end, C carries a price to sales ratio of 23 at the share price of 246. Now, and this person, their organization has the word compounding as part of their name. So I decided to do a Control F and look for the term capital allocation, and I could not find a mention of it anywhere. I went to other blogs and I could not find it. Now, whenever someone claims that the person is a long-term investor and there is no mention of the word capital allocation, then instead of a Control F, you can just give that blog an F grade and unsubscribe and move on. Now, in the past, and by the way, these are all friends. I know this person personally. In the past, we used to be very nice in MoneyWiseSmart, but I realized that us being nice did not serve our subscribers well. In fact, I take partial responsibility for not being forceful enough in the past when I came across stuff like this. I mean, someone is so bullish that it does not even occur to them that, first of all, 130 price to free cash flow ratio is absolutely crazy. And that too with the assumption of a 20% free cash flow margin, which doesn't exist. But anyway, so the person who shared this blog article, I mean, I explained that, this is a bit risky. And then we had a long discussion. It was a discussion where a lot of people participated, and I had a long chat with this person. He also is, by the way, a friend, and I spoke to him yesterday and told him that, hey, I'm going to talk about it. So I kind of took his permission. Now, I wanted to show this to show that how, and these are all smart investors, by the way, but when we get, and it happens with, and I'm not immune from that. I mean, it has happened to me several times in the past that when we believe in something very strongly, we completely wear blinders and we completely block off all facts and figures which kind of contradict our beliefs. So you can see that that is clearly what was happening in this particular case. The growth assumption in free cash flow that this person was modeling was 65% year-on-year growth assumption, an implied free cash flow margin of 20%, terminal multiple free cash flow assumed 40x, which means a 2.5% free cash flow yield, leading to an implied revenue CAGR of 45-46%. And he also pointed out that Garena, which is their digital entertainment business, had a ARPU of 1.7. And here, look at some of the other assumptions using a 40x multiple and 15% discount rate with a 2% dilution of total outstanding shares. The intrinsic value works out to 261. So to which this is what I had commented. And as you can see, it was 2 years back. And let's spend some time going through this. Here, my comment was, I obviously do not know enough about C yet to comment on these numbers. However, just gather from what you posted that you're expecting a 15% expected investment return based on continuous 65% year-on-year growth of free cash flow with a 2% dilution. I'm scratching my head because I'm trying to find out how many companies have ever managed to continuously generate a 65% year-on-year free cash flow growth out of the entire universe of businesses. Now, this is something which just occurred to me as extremely aggressive. So what is the base rate probability of C achieving the same? Maybe they will turn out to be an exception. And then the question of how they are going to allocate the capital. So even if C managed to, let's say, magically generate that kind of free cash flow, how are they going to allocate the capital? Because remember Fan Liang's example, to achieve that 15% investment return, the capital that they're generating also needs to be invested at 15%. Just generating an operating performance, delivering an operating performance is not good enough. And then the next point I made, the share dilution over the last 2 years have been 19%, whereas you were assuming 2% going forward. So it was just not falling in place. And by the way, I did not know much about C Limited at that point of time, but these assumptions appeared to me as very, very out of place. And then I asked, are there more conservative ways of generating a 15% investment return instead of an investment where everything needs to go right and the dilution needs to be magically different from what it was the last few years? I mean, I guess time will tell. And then I also added, by the way, I will be happy if it turns out the way you're saying, because I'm an indirect owner. Why? Because at that point of time, I used to own Tencent, and Tencent owned part of C Limited. So let's look at the reality, the actual numbers after 2 years, which is as of now. Their year-on-year revenue growth as of the 6-month figure was 5.2% compared to the predicted 45%. The digital entertainment ARPU, which was supposed to rocket beyond 1.7, worked out to 81 cents. Now, when this is also another example, when investors are so bullish, that they are completely blinded, they forget to ask a very important question, that can something go wrong? I can bet in 2021, no one was giving it a consideration that, you know what, a country like India could be banning their most popular game, or something else can go wrong. So as if those considerations did not exist. And the reason I'm spending so much time, and we still haven't looked at how good the business is, we are still at the stage where we are doing a forensic analysis of C as an investment. The free cash flow margin remains a far cry from the predicted 20%. In fact, it remains elusive. So I have no idea how, otherwise smart people made assumptions and their entire thesis based on a 20% free cash flow margin. Here is the clincher. The US interest rates at that point of time was 1.63%. And if I show you the thread, there were comments like, oh, I don't expect the US interest rate to be too different. Well, here is news. The US interest rates have shot up by 3x since then. And what do you think happens to a business which is not free cash flow generating? The discount rates go up, and that pulls down the valuation of the business. And last but not the least, the latest GAAP results, if you look at C Limited's GAAP results, they actually announced a profit. However, if you look closely, that net profit is more of a result of massive reduction in their sales and marketing expenses, which is not sustainable. In the 12 months leading to this June 30th, their sales and marketing expenses have gone down by $1.1 billion compared to the previous period. And how do I know it's not sustainable? Because Forrest Lee told me that in their latest transcript. If you read it, he himself clearly talks about increasing investments again, and that will lead to short-term losses. So C, unfortunately, did not end up as a good investment for many trusting investors because of dangerously flawed predictions. It was absolutely priced for perfection, and only then could you have justified a $260 or $250 share price. And everybody wanted in because they were driven by flawed analysis and completely delusional growth predictions. Now, that is not investment. That is speculating. Now, as I mentioned, now today I know I'm coming across a bit harsh. I should have done that 2 years back in this long thread. I was extremely civil, and tons of data was being presented there. Probably I should have been harsh at that point of time. That would have saved a lot of money for our subscribers. But I think it was my failure. I didn't do that. Now, it was not a good investment, but is C actually a good business, as we have been made to believe? So let's again look at the numbers. So this is where a pure fact-based forensic analysis follows. Now, again, 2 years back, I had done this analysis, and I had realized that C actually had a significant jump in their revenues, and they hit the $10 billion mark in just a 9-year period, which is a whopping CAGR of 80%. So anyone who looks at this would be very, very impressed. But the important input that is missing from here is what is the amount of capital that went into the business to generate this impressive CAGR growth. And you will realize that the CAGR in the amount of capital employed in the business was 107%. Now, of course, there is one caveat. C decided to raise a lot of capital when the share price was high. That's not necessarily a bad idea. In fact, that could be a smart thing to do, provided that cash was used judiciously, and we will soon see how it was used. So I provided this comparison because a lot of people were calling C Limited as the Amazon of Asia. So here is an actual comparison with Amazon. Now, Amazon took 9 years from a similar start to cross that $10 billion mark. But to do that 61% CAGR, which is slightly less than C's, it required only $1.8 billion of capital as compared to C's $11.6 billion of capital. Now, one of the C bulls immediately commented, but a lot of that cash that C generated is actually there on the balance sheet. Yeah, it's true. So even if I take that cash out from the capital employed, still C Limited used up about 4x of capital that Amazon used to cross the $10 billion. And when it comes to dilution, this is what their dilution CAGR looks as of now, 13.2%. You remember the 2% assumption, assuming a dilution of 2%. Here is the reality, a 13.2% dilution is what C Limited suffered over the last 5 years. So you remember I was pointed out about the cash which was there on C's balance sheet. So if you paid attention to Fund Liang session, you would realize that this cash is only valuable if this cash is invested and if it generates a high return. So let's take a look at C's capital allocation. Now, I don't know where people found that free cash flow of C. This is the last 3 years, and C has generated no operating cash flow. Okay, this is the cumulative. And by the way, here for those of you who are new, when you want to look at cash flow, don't just look at 1 quarter or 1 year's figures. Look at the last 3-4 years, because there is going to be quite a bit of volatility. So you need to normalize the numbers. So as you can see, over the last 3 years, there was no operating cash flow that C has generated. So where was the cash coming from? If it was not generating the cash internally, either it would be borrowing money or it would be raising equity capital, right? And that's exactly right. So C was doing both. It was issuing a lot of shares, it was raising a lot of capital and equity capital, and it was also raising a lot of capital through convertible notes. And what were they doing with this capital? Because as you know, someone pointed out that $11.5 billion of capital was not fully spoken for. So it must have been still on their balance sheet. So this is what they were doing. They were purchasing a lot of investments with that capital. So between these 2 years, just look at it, almost $5.1 billion of investments. They were acquiring, making some small acquisitions, and they had their credit business where they were giving out loans to their sellers. So let's evaluate each of these 3 and see, because if we have to evaluate a business's capital allocation, typically it requires a long track record. Unfortunately, C does not have that long track record. So we have to make do with whatever data is available, and then we have to do some extrapolation. So in these last few years, this is what has happened to, so we talked of those 3, right? First, let's look at the investments. So they have these long-term investments, which are mostly debt securities, and there are some equity securities. And as you can see, that the fair value is below the cost or amortized cost. So it's not that they have already generated a very high return on these investments. Let's look at the acquisition track record. Now, here is looking at it really under the microscope. You will see at the end of 2021, they had about $540 million worth of goodwill and acquisitions. Now, come next year, 2022, $355 million of that was impaired, which means clearly, why do you impair goodwill? When you realize that those acquisitions are probably not going to work out the way you expected. So $355 million here. And then fast forward another 6 months, another $118 million. So 355, 455, 465, $473 million out of this $540 million, which is almost what? My mental math is not that good. 80% of what they have acquired is already impaired. So that's the track record of their acquisition. And here is what's happening to their loan receivable. So C currently has about $2 billion of loan receivables, net of allowances, and they provide for credit losses. So as you can see, $330 million on $2 billion is over 16% of whatever loans that they have given out. So if they have to provide for over 16% of loans, that does not tell me that that is a stellar performance. So here is your capital allocation track record, your investments, your loans that you have been giving out, and your acquisitions. Now, the blog that we read also talked about the optionality that Free Fire, which was the Garvena's main game, provided. And this is what he had written. Sticking with C's optionality, Free Fire could also expose the company to the potential of the metaverse, gameplay, blah, blah, blah. This sounds like Free Fire could in future be the game that intermingles the physical and the virtual lives of users. And plus, you remember those aggressive projections on the ARPU of Free Fire. So I wanted to see how Free Fire is doing subsequently. Now, remember, this blog was published in May 2021, and not surprising because that is where the popularity was at the top. Now, these screenshots, for those of you who don't know, it's from Google Trends, where any keyword you can go and do a search on how many people are searching for it and what has been the trend lately. And here are the YouTube searches, here are the web searches, and this is worldwide over the last 5 years. So you can see the trend for yourself. So these are some of the facts which I noticed, which I think if you're a C subscriber, you should take these facts into consideration and then make your own recommendation. As I said, I am not invested in this business. I don't plan to, and I don't have an opinion about that business. Maybe you have identified something which negates all these facts, but the decision is yours. Now, that brings me to this concept of investing in innovative businesses. Now, we often come across very innovative ideas, which typically, attract a lot of investors. A lot of investors rush in because they feel that, this is the next big thing. So I want to take you through a history lesson. Now, this picture is from 1910. This is one of the US roads. And as you can see, the main mode of transportation, land transportation at that point of time, was horse carts. Now, in the next 10 years, there was a major innovation that changed the face of the country and the world, which is motor cars. So this picture is from 1920. Now, just imagine, transport yourself back to that period of time and imagine what investors would have thought that, hey, this is obviously, a hot innovation. So obviously investors rushed into it. And no wonder the number of American car manufacturers in 1920s was more than 2,000. And by the depression of 1929, that number had shrunk to just 98. And during the 1930s, the height of depression, this number dwindled all the way down to 44. So 44 car manufacturers. I'm pretty sure if you did not know, and if I told you that in US at one point of time, there were 44 car manufacturers, you would have raised your eyebrows because you know how many are there, how many are left now. Less than 10% of these 44 are remaining, and that too, some of them needed a lifeline in 2008. And then if I told you that at one point of time, this number used to be more than 2,000 or 3,000, you would have probably not believed me. So there goes your innovation investing. Now, there are other innovations that benefited us over the last 100 years, the airline, the internet, EV, and AI now. And let's not forget all the financial innovations in between. The important questions which investors, typically investors like Cathy Woods and her followers, forget to ask during these frenzies, which also seem to be the question which people who rushed into the companies which we just analyzed, they seem to have forgotten is, are these innovations able to generate a return on capital that is greater than the cost of capital? Because in the long run, that is the only thing that matters. Whatever the CEO might be telling, whatever grand plans that they might be having, in the long run, to enjoy a performance that, that lady who stayed on with Asian Paints and got a 1,000-bagger, it is not possible for that for you to enjoy that kind of performance unless your return on capital is significantly greater than your cost of capital. And if the answer is yes, the next question is, will the excess return last long enough? And the third question is, how has the CEO's capital allocation track record been? Now, thinking first principles, the simple formula which we like to remind everybody is that future value of an investment is nothing but the present value multiplied by 1 plus rate of return raised to the power n, where n is the number of years. And that is our primary, in MoneyWiseSmart, that is our primary focus, because that talks of the longevity of a business. So when we look at a business, now all these three businesses that we analyzed, could these businesses completely turn around and last for the next 50, 100 years? Yeah, of course they can. Maybe they're amazing businesses. I have no idea. I have just studied their numbers. So as investors in those businesses, this is the question that you need to ask yourself, that what is the chance of some of these businesses getting disrupted? Now, we might come across good-looking businesses from time to time, but the risk of ignoring first principles is that from an investment point of view, it could end up being this. So with that, I hand it over back to Fanya to take the next section.
So now let's move on quickly to the earnings updates for some of the MRIs companies. As we've already published the full earnings updates for the MRIs companies on Teachable, so you can check them out. And now we'll just quickly go through some interesting updates like that for StoneCo, which many of you have requested. And then we'll highlight some interesting developments for Process, Wise, and HDFC Bank. So for StoneCo, as we have mentioned before, its strategy is to acquire new payment clients first. And then after that, you'll gain their trust, and after that, gradually cross-sell them other solutions like software, banking, working capital, and credit services. So one of the key factors driving StoneCo's long-term growth will be the growth of its clients, which grew quite well in the last quarter by 43% year-over-year to about 3 million clients. That helped to drive the total payments volume to grow by about 19%. And what's important is that this growth was 3.7 times the industry growth, allowing StoneCo to continue getting market share from the legacy banks, showing its strength and leadership in the market. So revenue grew 28% year-over-year to about 3 billion Brazilian reais. And due to operating leverage, you can see here the net profit margin it actually improved to almost 11%, significantly higher than the past few quarters. The banking business also continued to grow well, with the number of clients growing rapidly, and with the increasing banking penetration among its existing clients and future upselling of more banking products, the banking business could contribute well to StoneCo's overall profit growth. We have discussed StoneCo's latest valuation and some other developments in our full update. So for those who are interested, you can check it out on Teachable. Next process, the key update is the progress of its good capital allocation, where because it has been selling its shares in Tencent and using the proceeds to buy back its own shares, which were trading at a relatively lower price, it had managed to increase its net asset value by 4.5%, purely due to the effect of this capital allocation activity. And the good news is the company is in the middle of removing the existing cross-holding structure to simplify its group structure, and that would help it to continue execute its buyback plans more easily and grow its NAV per share at a faster rate. We have discussed the other details of the earnings, including the latest NAV in the full update on Teachable. Next, for Wise, we first covered this company in March last year, and back then we said that one of its modes is its cost advantage mode turned into a scale economics shared flywheel, as Wise aims to return some scale benefits back to the customers. Back then, Wise had only been listed for I think about half a year, and we said that we wanted to observe it for a longer period. And now it has been listed for about 2 years now. We see that it has been executing reasonably well, growing its customers well by a CAGR of 32%, mainly from word of mouth marketing. And it has also managed to keep its fees charged to customers relatively low and stable, despite the volatile markets in recent years. And more importantly, recently it has been strengthening its low-cost turn scale economic shared mode by returning the net interest income that it earns on customer deposits back to the customers. So instead of keeping the net interest income as profit for itself in this rising interest rate environment, Wise actually proactively chooses to give back some of them to the customers. For example, by providing cashbacks or allowing customers to invest in interest-earning assets backed by the government through Wise Assets. And in Singapore, for example, you can invest in Singapore government bills to earn about 3.7% annual interest rate now, which is quite good compared to the other banks in Singapore. So with Wise continuing to return some of its scale benefits to its customers, its competitive advantage is likely to get stronger relative to the traditional banks or money transfer firms, making it a strong company. However, as shared in our full update on Teachable, Wise is still in the middle of finding practical ways to return the benefits to customers fully. So its current profitability is temporarily inflated by the net interest income. So in valuing Wise, we just have to be careful with that and take that into account in the valuation. Okay, lastly, a quick one on HDFC Bank. When we first covered it in late last year, we said that the bank was undergoing a merger with HDFC Limited. And post-merger, HDFC Bank would have lots of opportunities to cross-sell various banking or home loan products to the existing customers of either HDFC Bank itself or HDFC Limited. And that the CEO actually thinks that the merger would provide HDFC Bank with a long runway of 50 to 100 years of compounding, which is a very good thing and is the type of longevity aspect of a business that we want. So the merger had now been completed successfully in July, and the integration is going well, so that's good. And also during our recent trip to India, Rupam and I have been talking to the people there and other investors there, and we have only heard good things about the bank and did not discover any new red flags that we have not discussed already in our analysis. So that's reassuring for us. And that's all for a quick round of updates. As I said, for the full updates of all the MRS companies, you can check them out on Teachable. So today, we have covered quite a few topics in this meetup. First, we talk about the various steps of performing portfolio review and evaluating businesses. Then we discuss how we look for red flags and our forensic analysis findings on some companies requested by our subscribers. And lastly, we talk about the latest updates for some MRS companies. Based on what we have presented so far, do you think that doing proper portfolio review, including evaluating the business performances and modes over time, assessing the capital allocation, and spotting red flags should form part of your compounding framework to compound your long-term investment return? If you think it's important, type CF in the chat, which stands for compounding framework, to compound our wealth. Yeah, so now to identify good companies to own, and then to monitor the company's developments, financials, and capital allocation over a long period of time as part of the portfolio review, it requires a huge amount of work, including in-depth analysis of many years of financials and reading of the annual reports. However, for our subscribers, we have done covered with our compounding framework. We do the heavy lifting by reading all the company documents, summarize the findings in easy-to-digest format, just like the summary valuation Google Sheet that we showed you earlier. It contains the 5 financial metrics of the companies over the years, together with the commentaries on positives and negatives. We also publish their latest valuation based on the most conservative estimates of cash flows, and not on any kind of aggressive growth predictions. In short, we basically want to make it very easy for our subscribers to not only select high-quality businesses, but also be on top of their companies.
At MoneyWiseSmart, we do deep dive research into wonderful companies to own for the long term. We have provided some of this research for free in our free research series. So definitely check them out at the link provided if you want to invest in good companies. I promise you will really benefit a lot from this research. If you have enjoyed this video, do hit the like button now, and don't forget to subscribe and hit the notification bell so that you'll be notified of our future videos. Do also join our Facebook group where we discuss interesting investment concepts and businesses. Thank you for watching, and see you in our next video.